Well, it's the economy. The Reserve Bank's MPC minutes that were published yesterday clearly indicate that the committee unanimously sees scope for a rate cut to support growth. All members said that they're waiting for earlier policies to play out. Since the October 1 policy, we have also had the September inflation data, which has again undershot the Reserve Bank's forecasts. Chances are October-December CPI forecast of 1.8% from the Reserve Bank may also be undershot. There are people who expect it to come in at 1%. To understand more about whether the Reserve Bank will concentrate on growth or inflation when it sets policy rates in coming meetings, I'm joined by the external member of the MPC, Dr. Saugata Bhattacharya. Saugata, thank you very much indeed for your time. Well, actually, that is the question bothering the market, bond dealers. What will the MPC concentrate on? As you argue in your minutes, growth looks very resilient, and yet inflation is way below the MPC's lower bound of 2%. So what will you all concentrate on?
Well, so good morning, Lata. Thank you very much once again, for having me on your show. Always a pleasure. So I think the members unanimously, I can't do better than the quote, the minutes. That in the inflation trajectory, particularly in the next couple of quarters, gives us space to ease policy further. But again, the basic question remains that given as you know, that monetary policy being forward-looking, you have to look at the trajectory of inflation going forward. We knew that inflation in September, the months of October, would be low given the very high base that you remember last year in September and October. And after that, inflation thereafter begins to taper off, and that will begin to increase the inflation print going forward. So that is one point. So there is absolutely no doubt that this inflation trajectory that is now that the RBI has forecast opens up space for further easing. Now it depends, because there are so many conditions, so many other uncertainties that color our thinking, color our views, that this has to be done on a meeting-by-meeting basis. So I think there is scope for further rate cuts, but let's see how things move, what happens to the India-US trade deal, the India-EU FTA, etc. So there are so many moving parts in this current environment that let's see how things evolve over a period.
There is a chance of things coming in favor of growth, right? Because of the WPI being so low, the last number we have for September is 0.13%. I mean, when it's as low as that, the deflator of the GDP also comes in much lower. The expectations are that the second quarter GDP will also be, 7% or more. Yes. I mean, that's what I got from the street. As well, it's possible that a trade deal, we're very close to a trade deal before you all meet on December 6th. So if things are very pro-growth, is there a window that you may not, use that space at all because growth doesn't need help? Is that a possibility?
That is certainly a possibility. I don't think, because all of us know that this is now common knowledge, the information set that all of us are working with, that growth, as you said, Q2 growth is also likely to be strong. But then again, the same thing as in inflation, Q3 and Q4 growth onwards, that might begin to come down. I mean, it's not a bad number, 6.2%, that is now getting forecast for H2. That's not a bad number. But again, probably I think we also need to learn a little bit more about the analytics of our potential growth, etc. So that is work in progress. We need to figure out how much room there might be for further growth without heating up the economy, which current indicators seem to suggest that we have room to grow a little bit further. So again, all of these are factors which come in. And of course, when you're looking at not just the macroeconomic, but the macro-financial, the environment that we are currently facing, that is something that we need to figure out. And particularly, as I've said that again, in your show the last time that we were there,
yes,
that the external balance is still not looking very good.
Yeah.
So despite the trade numbers that we got yesterday, and that of course is colored a little bit by gold silver imports. That's a one-off number probably. But other than that, there are still issues concerning our external balance, particularly, as I said last time around, the capital side of the balance.
Yes.
So again, that again is yet one more factor that goes into the MPC decisions.
Okay. No, I completely agree with you that, we don't know about the second half growth. And if you look at Asian economies, the growth picture is not at all looking good. If you look at Indonesia, Malaysia, Thailand, a number of, economies and the chances of being dumped with excess Chinese capacity. So would you have severe worries about growth at all? I'm asking you the other end of the question.
I wouldn't categorize it as severe worry, but certainly if the 50% tariffs persist on India, because the geographies, the UAE, China, Southeast Asia, etc., will probably not be able to offset. And remember that everybody is trading within this without a trade deal, that everybody is trading within this limited set. So it will not offset the loss of markets that we might see in the US.
Yep.
And particularly, it's not just the merchandise trade, even the services trade system might get impacted with the other measures that we have seen.
Yeah.
So work in progress. I don't know how things will move, but that is a risk. Yes.
Okay. If you can put on your economist hat, that's what you've been wearing anyway. What have you made of the ECB measures? They're only draft rules, but end-use restrictions have gone, pricing restrictions have gone. Are you getting, and even time, most of the ECBs can now be 3-year. You don't need, the minimum of 5 to 10 years is gone. Are you expecting that to loosen, or to increase dollar flows? Will that remove the pressure on the currency? Not strictly an MPC question, but still, what have you made of that?
I get it. Obviously, I think there is space to increase inflows, capital inflows, both equity and debt, and particularly in the case of ECB, external debt. So I think particularly remember, go back to the fundamentals, that there is now a problem with global savings. So the global savings that we had seen in the past, the huge pool, the savings glut, and then even that, so that probably is now gone. China is not exporting savings. The quantitative tightening from central banks is also beginning to cut down on the savings pool. So, and other countries also, particularly the US now, given the inflows, FDI inflows, other investment commitments into the US. So we are fighting. India will probably be fighting for the limited pool of savings. We need to get access to savings.
Okay.
There are risks and returns to increasing ECB. Obviously, foreign debt might be risky at some point in time. But I think India's external debt at $750 billion, I think it's still relatively okay. I think we can absorb more capital inflows, and particularly now with this savings pool, with domestic savings now flowing outside, as you're seeing the IPO numbers, etc. So probably enlarging the pool of potential savings, the pool of capital, might actually be a good thing at some point.
Okay. Now, fair enough. And you're also saying that it is coming at a time when anyway we have to fight for savings harder. So it's not necessary that if we loosen the rules, money is going to flow because the kitty itself is smaller. Saugata, what about the way in which you look at 1 year forward inflation? Ultimately, that seems to be the more important parameter that the MPC is looking at. The Reserve Bank's forecast has been consistently about lower. They started at 4.9 for the June quarter. Now they are at 4.5. Given the undershoot in inflation currently, the base gets lower, and there are a bunch of economists who believe that next time in the December forecast, they may bring the June quarter down to 4%. So, does that also increase chances of a rate cut? And in your mind, is there at all space for more than a cut? More than one cut?
More than one cut. You're absolutely right that the inflation forecast that RBI, the survey of professional, the median of the survey of professional forecasters have been consistently overestimating. And I'm also I want to understand the dynamics of food prices a little better. What is causing this level of disinflation? The sowing area, etc. So we know, but it's still, it's been consistently been lower than what we have been estimating. And remember, once again, it's not just a matter of how much space there is for rate cuts. Too much disinflation is not good. Even if the core inflation is still okay, but even if you strip out the gold prices, the super core inflation, even that is very low.
Yes.
This is not good. There needs to be a certain level of inflation for private investment, for production decisions, etc., to be put into effect. So too low an inflation number is also not desirable.
Yes.
But given all of this, that inflation, given the base effects, given whatever we might see of higher growth in the global economy, commodities prices moving up a little bit, etc., will begin to push inflation up. I'm still going with the RBI's forecast at this point in time, 4.5 in Q1, and etc. But you're absolutely right that there is space for rate cuts. How many, how much, how deep? Difficult to predict at this point.
I take your point. It's just that the Asian disinflation is a little scary. So it's not just food. And that's why I was asking you if there is space for more than one. Thank you very much, Saugata Bhattacharya. And we do hope we will get a chance to interview you before, not just have this policy-wise meeting, but sometime in between as well. Thank you very much. And Diwali greetings to you and yours. Well, that's the word coming in from one of the external members who has voted for the rate cut and for keeping the policy neutral. We'll wrap up on Bazaar on that note. Chat process coming.